2013 will be another slowish year for China with real growth of 7.8% forecast. Now, this isn't necessarily a bad thing. It just means that China is decelerating slightly and moving towards a more sustainable growth path. So between 2008 and 2012, average real growth rates were 9.2%. Between 2013 and 2017, we're going to see them slow to 7.6%. So this just means that China is basically moving away from more investment-led growth strategy to consumption-led growth strategy. So basically, we've seen, interest rates dropping, reserve requirement ratios for the banks have been dropping, and the Chinese government is basically trying to stimulate the economy by incentivizing the Chinese to spend more. So real GDP in India is set to grow by 6.3% in 2013, up from 5.3% in 2012. Now, the Indian economy made several big steps last year in terms of reform. They've opened up their foreign direct investment market in terms of retail and the aviation industry, which will be a big boon for them in terms of attracting foreign investors. Now, it's still one small step for India, so, over the coming year, we should see them, pursue this reform path. So there is a threat that the sovereign debt rating of India may be downgraded to below investment grade in 2013 if policy slippage or further economic slowdown occurs. We saw a large slowdown in Brazil in 2012. There was a massive slowdown in their automotive industry, one of their most important industries. But we are expecting to see a pickup in economic activity in 2013. So this year, we're expecting the Brazilian economy to grow by 3.2%, up from 0.9% in 2012. Now, Brazilian consumers are unique in their steadfast spending, and we're expecting consumer expenditure to grow by 6.3% in real terms in 2013. The government is trying to move away from a consumption-led growth strategy to investment-led. So if you like, they're on the other side of what China is trying to do. So Brazil is hosting the FIFA World Cup and the Olympic Games in 2014 and 2016 respectively, and they're using this as an opportunity to drum up investment in the economy. Now, they're doing this in two ways. They're offering tax incentives to basically draw people in, private investors, to put their own money back into the economy, as well as upping their own infrastructure spending. And we should see this give a fair bit of impetus to the Brazilian economy over the next 5 years. 2013 is going to be a really important year in Mexico. It's the year that it's going to become the 10th biggest economy in the world in purchasing power parity terms. And it's also going to be competing a lot more with China for manufacturing jobs and things like that, as wages in Mexico have stagnated slightly and now they're parity with Chinese wages. So for US investors and US manufacturers, there's an option there for them to nearshore and, put money into Mexico rather than sending jobs all the way to China, as we have been seeing. On to South Africa, which has slightly disappointed over the last few years, falling behind its BRICS stablemates. Now, 2013 will see an upturn in the South African economy, we're hoping, as the government has responded to the Eurozone debt crisis and the economic downturn with considerable stimulus. However, if the Eurozone debt crisis worsens in 2013, there could be a considerable threat for South Africa because 21.5% of South African exports went to the EU 27 in 2012. So the final thought I want to leave you with is that 2013 will be an important year for the emerging market economies. The key aim for them really should be this year to continue on the path of reform that we've seen them on over the last 12 months ago, particularly if they want to continue the growth rates that we've seen over the medium to long term.